Traders, investors, and silver stackers, welcome back. If you have been watching the markets over the last week, you know exactly why we are here today. Panic, volatility, and a question that is burning in the mind of every single person holding a position in precious metals right now. Is the bottom finally in? We have watched silver take a massive hit, dropping all the way down to a low of $64.06. For many, this is a nightmare scenario. But for the seasoned technical analyst, for the smart money, this specific price level isn't just a random number. It is a signal. Today, we're going to tear apart the charts. We're going to look at a specific article and forecast that suggests we are sitting on the edge of a massive reversal pattern. We're talking about a potential bounce that could redefine the trend. But, and there is a big but, there are headwinds coming from the CME group regarding margin requirements that could crush the small trader. In this deep dive, we are not just reading the news. We are analyzing the why and the how. We are going to break down the 200-day moving average, the psychology of old tops becoming new bottoms, and the specific closing price reversal pattern you need to watch for today. So, grab your notebooks, because this is going to be a masterclass in silver trading. Let's dive in. Alright, let's set the stage. Spot silver is currently edging higher on Friday. We are seeing a rebound from a trade to its lowest level since December 27th, hitting that crucial mark of $64.06. Now, why does this matter? Why did the price stop there? To the untrained eye, markets move randomly. But to us, this level screams opportunity because of historical context. Let's look at the data. The intraday low came in just above a target that many analysts had their eyes on. 59.34. Now, pause the video if you have to and look at your long-term charts. 59.34 isn't just a support line, it is a legacy level. In my opinion, and based on the analysis we are reviewing today, this was the breakout price. This was the launchpad that ignited that historic rally, which took us all the way to the all-time high of 121.67. Think about the psychology here. When silver originally broke past 59.34, buyers flooded in. It was a moment of euphoria. Now that prices collapsed back down near this level, those same buyers and new investors are looking at this zone as a second chance. This brings us to one of the oldest and most reliable adages in technical analysis. Old tops can become new bottoms. When a ceiling is broken, it often becomes a floor. The market has memory. The fact that silver halted its crash at 64.06, hovering just above this 59.34 breakout zone, tells us that the bulls are stepping in to defend this territory. They are building a fortress here. But there is more confluence in this area. It's not just about the breakout level. Right in this same neighborhood, specifically at $60.835, we have another critical metric. This number represents exactly 50% of the all-time high. Let's use some common sense here. If you loved silver when it was trading at its peak of 121.67, if you were experiencing FOMO, fear of missing out, at the top, then logic dictates you should like it twice as much at half the price. This 50% retracement level is a psychological trigger for value investors. It's the ultimate discount tag. When you combine the breakout support of 59.34 with the 50% value level at $60.835, you create a confluence zone of support. This explains why the $64.06 level acted as a temporary floor. The market is sniffing out value. However, we cannot be blind optimists. A professional trader always looks at the downside risk first. What happens if this floor cracks? What happens if the selling pressure overwhelms the buyers at $64? The major downside target is the 200-day moving average, currently sitting at 50 $. For those new to trading, the 200-day moving average is the line in the sand for long-term trends. If the price is above it, we are generally in a bull market. If we crash below it, winter has arrived. Notice where this average sits, $50. This is virtually identical to the psychological round number of $50. Human beings love round numbers. We place our stop losses there. We place our buy orders there. If silver fails to hold the current levels of $64 and $60, the magnet pulling it down will be that $50 mark. That is the critical risk level. It is the do-or-die line for the silver bulls. So, we have established the battlefield. We have the support fortress between $59 and $64. We have the abyss down at $50. The question now is, how do we know when the bleeding has stopped? How do we identify the turn? Many amateur traders try to catch a falling knife. They simply buy because the price is low. That is how you blow up your account. We are not interested in just any low price. We are interested in the pattern. Specifically, we are looking for a closing price reversal bottom. Now pay attention, because this is nuanced. We aren't looking for the textbook definition, where you simply have a lower low and a higher close. We need confirmation. We need strength. The analysis suggests a very specific set of criteria to confirm that the bottom is actually in. Here is the checklist for a valid reversal in this volatile market. A close above the opening price. The bears might control the morning, but the bulls must win the day. A close above the midpoint. If the daily range is $2, the price needs to close in the upper dollar. This shows that buyers aren't just nibbling. They are pushing price up aggressively into the bell. Volume. We need volume that is better than average. A reversal on low volume is a trap. A reversal on high volume is a statement. Let's look at the numbers right now. Yesterday's close was 70.94s. Today, the market opened at 71.10. The midpoint of today's trading range so far is 69.71. These are the three key numbers on your dashboard. Based on the work we are analyzing, the magic number to watch is $71.10. If silver can manage to close above $71.10 today and do it on strong, heavy volume, that will signal a pretty solid bottom. It tells us that despite the drop to $64, the market has rejected lower prices and is ready to resume the uptrend. However, time is also a factor. The best time for a major reversal bottom is usually after a 7 to 10 day break or correction. Currently, we are only on day 6. This means the timing isn't perfect. It's a little early. This imperfection means we have to be cautious. We can't go all in just yet. We need to see if the price action can overcome the timing deficit. So, let's say we get that close above $71.10. What comes next? A bottom is only a bottom if the trend changes. What are the hurdles silver needs to jump over to prove that the bull run to 121 is back on? This is where we bring in the Fibonacci retracement levels and the shorter-term moving averages. These act as the resistance, the ceiling that the bulls need to smash through. First up, we have the 61.8% retracement level at 74.63. In the world of Fibonacci, the 61.8% is the golden ratio. Algorithms, high-frequency trading bots, and institutional traders are all programmed to sell or take profits at this line. Reclaiming this level is the first sign of strength. Right above that, we have the 50-day moving average at $77.04. The 50-day is the heartbeat of the intermediate trend. Being below it means we are correcting. Getting back above $77.04 puts the wind back in the sails. And finally, we have the 50% retracement level at 83.60. These are your targets. These are your milestones. If we bounce from $64, you watch $74, then $77.7, then $83. Each level reclaimed strengthens the case that the bottom is in. But there is one level that matters more than all of these. The king of the hill for this chart. The trend on the daily chart will only officially turn up if buyers can overtake the swing top at 92.20. Until we break 92.20, we are technically still in a corrective structure. But if we break it, then the path to new highs is open. If $64.06 truly ends up being the bottom and the trend flips, we could see a near-term surge back into the 50% level of the entire drop, which sits at $92.87. But wait, before you rush to your broker to place a buy order, there is a storm cloud on the horizon. A fundamental change is happening behind the scenes at the exchange level that could kill this rally before it even starts. It involves the CME group, margin requirements, and the deliberate crushing of volatility. We are going to discuss this headwind in the next section, because if you are a small trader, what I am about to tell you could save your portfolio from liquidation. We talked about the charts. We talked about the potential for a reversal at $64 and the breakout level at $59. The technicals look promising. The pattern is forming. But remember what I told you right at the end of the last segment? I told you there is a storm cloud, a headwind, something that has nothing to do with charts, nothing to do with supply and demand, and nothing to do with how much you love the metal. It has to do with the rules of the game being changed while you are still playing. According to the analysis we are reviewing, there is a massive obstacle that could kill this attempt to reach a short-term bottom. The CME Group, the Chicago Mercantile Exchange, the world's leading derivatives marketplace, has again raised margin requirements for silver futures contracts. Now, if you are new to trading, you might be asking, what does this mean? Why should I care? If you hold physical silver in a safe, maybe you think this doesn't affect you. You are wrong. The paper market drives the spot price, and when the CME changes the rules, the ripples turn into waves that crash into everyone's portfolio. Let's take a step back and do a quick masterclass on margin. When traders buy silver futures, they aren't paying the full price of the silver. They are putting down a deposit, a good faith deposit called initial margin. Leverage is great when the price goes up. You get rich fast. But when volatility hits, like the crash we just saw down to $64, the exchange gets nervous. The clearinghouse needs to ensure that if traders lose money, they can actually pay up. So what do? They raise the rent. The article highlights that the CME is raising margins specifically to dampen the risks associated with the heightened volatility over the past week. This change is set to take effect after the close of business on Friday, February 6th. This timing is crucial. After the close of business. This means traders are going into the weekend with a gun to their heads. They have to decide, do I deposit more cash into my account to meet this new, higher requirement? Or do I sell my position and get out? And this brings us to the most painful part of this analysis, the shutout of the little guy. What does this margin hike mean for silver prices? As the article states, obviously, the smaller player is getting shut out from carrying silver overnight. Let's break this down. The smaller player is the retail trader. It's you, it's me, it's the guy trying to grow a small account. When margins are raised, the big banks and the hedge funds, the whales, they have deep pockets. They can wire millions of dollars in seconds to cover the new requirement. They don't blink. But the small trader, he is already leveraged. He is already hurting from the drop to $64. Suddenly, his broker tells him he needs more money just to keep his position open overnight. He doesn't have it. So, what happens? Forced liquidation. He is forced to sell. Consequently, as the analyst points out, he can't hold it for a longer-term rally. This is tragic. Imagine identifying the bottom perfectly. You bought at $64. You know it's going to $120. You are right. But because the margin requirement went up, you are forced to sell your ticket before the train leaves the station. This is how the smart money shakes out the weak hands. The price might rebound after you are forced out. This mechanism creates a temporary artificial selling pressure. Everyone rushing to the exit at the same time to avoid the margin hike creates a bottleneck. So, the small trader is kicked out of the overnight club. He can no longer hold positions for days or weeks to capture that big trend. What is he left with? He is forced to become a day trader. The article makes a brilliant point here. If he's allowed to day trade, then he's going to have to be able to trade with laser accuracy, since he'll have to pitch it at the close. Laser accuracy. Think about the pressure that puts on a human being. Instead of buying and holding for a month, you now have to buy at 9 a.m. and sell by 4 p.m. You have to be perfect. You have to time the intraday swings. You are fighting algorithms, high-frequency bots, and market makers who know exactly where your stop loss is. This shifts the psychology of the market completely. Long-term investors bring stability. Day traders bring chaos. Day traders are jittery. They panic sell at the first sign of trouble because they have to be flat, zero positions by the end of the day. And this leads to a fascinating paradox mentioned in the forecast. The CME says they are raising margins to dampen or reduce risks and volatility. That's the official story. But in reality, the analyst argues, in my opinion, this could add to the intraday volatility. Why? Think about it. If thousands of traders know they must sell their silver before the market closes to avoid the margin hike, what happens at 3:30 p.m.? A massive wave of selling. Or if they are day trading, they are jumping in and out, creating choppy, whiplash price action. So, instead of a smooth recovery from $64, we might see violent swings, up $2, down $3, up $1. This headwind makes the pattern we discussed in part 1 much harder to trade. It adds noise to the signal. So, where does this leave us? We have a technical setup that says buy. We have a fundamental rule change that says beware. This is the classic trader's dilemma. If you are a physical holder, this is just noise. You hold the metal. But if you are trading paper silver, this margin hike is a trap waiting to snap shut on your fingers. The market is effectively telling the small player, step aside, this game is for the big boys now. However, there is a silver lining, pun intended. If the market can absorb this margin hike, if the price holds above $64 despite the forced liquidations, that is a sign of immense strength. It means the buyers are so hungry for silver that they don't care about the higher costs. They are eating up the supply regardless. We have analyzed the crash. We have analyzed the reversal pattern. We have analyzed the margin trap. Now, we need to put it all together into a coherent strategy. How do you actually trade this? Do you wait? Do you buy the dip? Or do you run for the hills? In the final part of this masterclass, we are going to synthesize all this data. I am going to give you the summary of the key levels to write down on a sticky note and put on your monitor. We will decide, is silver a buy right now? Join me in the conclusion. We have journeyed through the crash to $64. We have dissected the anatomy of a reversal pattern. We have exposed the hidden dangers of the CME margin hikes that threaten the small trader. Now, we arrive at the moment of truth. Information without action is useless. You have the data, but what do you do with it? How do you navigate a market that is offering a historic discount at one end and threatening a margin squeeze at the other? It is time to build our battle plan. First, let's simplify everything. I want you to look at these numbers. Write them down. Tattoo them on your brain. These are the coordinates for the coming week. Zone 1, the buy zone, the floor, 59.34, 64.06. This is where we stand right now. The 64.06 low is our current defense line. Below that, we have the historic breakout level of 59.34 and the 50% value level at $60.35. Strategy. If you are an aggressive trader or a long-term accumulator, this is the value area. This is where the risk-to-reward ratio is most attractive. You are buying near the floor. Zone 2, the confirmation signal, 71.10. This is the most critical number for the next 24 to 48 hours. Remember the rule. We need a close above $71.10. Not just a wick, not just an intraday spike. We need the market to settle above this price on high volume. Strategy. If you are a conservative trader, you wait. You do not buy yet. You wait for the market to prove itself by conquering 71 times until. Once it does, you enter the trade with confidence that the reversal is real. Zone 3. The trend reversal, 92.20. This is the long-term target. Until we break 92.20, the daily chart is technically still in a correction. But if we break this swing top, the door to $100 and eventually the all-time high of $121 swings wide open. Zone 4, the danger zone, 50.00. This is the abyss. The 200-day moving average sits at 50 ounces. If the margin hikes cause a panic and we lose the $59 support, the the price will magnetize to $50. Strategy. This is your ultimate line in the sand. If you are holding leveraged positions, you must know where your exit is. Hope is not a strategy. Now, let's address the elephant in the room, the margin hike. We discussed in part 2 how this shuts out the small player. So, how do you beat a rigged game? Option A, the physical strategy. If you are buying physical silver, coins, bars, the margin hike is actually your friend. Why? Because it might artificially suppress the paper price for a few days. If the price dips because day traders are forced to sell, that is a gift for you. You are buying real assets at a paper discount. You ignore the noise. You look at the $121 high. You look at the $60 price, and you do the math. It's a 50% off sale. Option B, the day trader's pivot. If you are trading futures or CFDs, you must adapt. The article warned us. He/is going to have to be able to trade with laser accuracy. Do not hold positions overnight during this transition period unless you have deep capital. The volatility at the open and the close will be brutal. Switch to smaller time frames. Take your profits quickly. Do not look for home runs. Look for base hits. The margin hike has turned a marathon into a sprint. Let's look at the psychology one last time. The article mentioned, old tops can become new bottoms. This is the most powerful concept in market structure. The market is testing your conviction. It is asking, do you really believe in the silver bull run? When price crashed from $121 to $64, weak hands sold. They panicked. But the smart money, they see the $59.34 level not as a terrifying drop, but as a retest of the launch pad. They are looking to reload. The setup is bullish but fragile. The pros, we are at historic support. We have a potential closing price reversal pattern. We are at a 50% discount from highs. The cons, the margin hike creates a headwind. We haven't had the full 7-10-day resting period yet. My analysis. Watch the close. If we close above 71.10, the probability of a bottom being in shifts to over 70%. If we fail and drift lower, we look to catch the knife closer to $50. Trading is not about predicting the future. No one knows for sure if $64 is the absolute bottom. Trading is about probability and risk management. Is it worth risking $5 of downside to potentially gain $60 of upside? At these levels, the math says yes, provided you respect the stop losses. Markets are designed to transfer money from the impatient to the patient. The drop to $64 was the test of patience. The margin hike is the test of discipline. If you can navigate these two hurdles, the potential surge back to 92.87 and beyond is the reward waiting on the other side. Keep your eyes on the volume, keep your eyes on 71.10. And most importantly, keep your emotions in check. The market doesn't care about your feelings, it only respects your capital. This has been a deep dive into the silver forecast. We covered the technicals, the fundamentals, and the psychology. If you found value in this masterclass, if you want more deep analysis that goes beyond the headlines, make sure to hit that subscribe button and ring the bell. We will be tracking this $71.10 level closely in our community tab.